Hello, everyone. Today on the final bar, we're going to focus on a couple key factors to pay attention to. Number one, we'll focus on sentiment. Last week we had a huge downturn in bullish sentiment. All of a sudden, this Monday we get the big sell off, the gap lower in the S&P, and now starting to recover from there. What has sentiment done this week relative to what we saw last week? Also, we'll look at some of the breadth conditions as well as a key set of ETFs, high beta and low vol, and what they should mean for you, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market activity using the power of technical analysis, using the technical toolkit, power of StockCharts.com to try to make sense of things in uncertain times. If you like volatility, you like uncertainty, you like up days and down days that seem to completely change the character of the market. This week probably has not disappointed with Monday's distribution following through from Friday's, low move, break below the 50-day, the gap lower on Monday. But so far, Monday, then Tuesday, the low point of the week. From there, it's been all about accumulation. We see cyclical sectors, things like energy, industrials, materials, even financials, having a pretty strong day today, all outperforming the S&P 500. The 50-day moving average remains in play. We talked about the four things to look for a rotation from a bullish phase to a bearish phase. We've had a couple of those, but a couple of them actually already rotated back bullish, just given the strength of the last couple of days. We'll look at all of that evidence and more the best we can. We have great guests coming up on this show. Next week on the 28th, we have Alessio Ritigliano. He's the crypto specialist at Wyckoff Analytics. On the 29th, we have Dana Lyons of the Lion Share Report. On next Thursday, September 30th, Jeff Weiss, one of my early mentors in the industry who really understands the long-term trend analysis better than anyone. Also, our next episode of The Pitch is coming up next week on the 28th. Check that out for sure. Go to stockcharts.com/the pitch. It's a monthly stock picking showdown. I'll be moderating a conversation with 3 guest experts, each pitching 5 ideas, and we'll discuss them as a group. Should be a lot of fun. You can see all the previous episodes at stockcharts.com/the pitch. Let's continue on with a segment we call the mystery chart. What we like to do occasionally is bring up a chart. We sort of remove all the identifying characteristics, or many of them, and ask the simple question, what is this chart? A little later in the show, we're going to reveal what the mystery chart is. We'll talk about why it's an important one to pay attention to. I'll just orient you to this. This is looking at the last 2 years. It's a daily bar chart. We're looking at a pretty severe decline from January 2020 to a low in April of 2020. So it actually bottomed out a little after the equity markets had further downside. From there, it's actually done well and has outperformed the S&P by about 30 some percent year to date, just hitting its first Fibonacci retracement level. So the question is, what is this mystery chart? We'll reveal that a little later in today's show. Let's continue on with our market recap, focusing on the activity today, but as much as possible, connecting the short-term movements of today with the long-term trend characteristics. The S&P 500 really pushing further on to the upside. Yesterday, we had the Fed meeting. We had a lot of choppiness in the afternoon as the minutes were released, as Powell's press conference was playing out. But in the end, the S&P really didn't follow through much through the close. Today, you certainly saw an acceleration to the upside, with the S&P peaking around 2 p.m., coming back and giving some of that back, about 15 points or so by the close of the S&P closing just below 4450. That's up 1.2% from yesterday's close. The NASDAQ composite up as well, but a little bit less, about 20 basis points below that, around 1% or so. Mid caps and small caps both outperforming. And if you look at the leadership today, it was energy up big, financials number 2, and those are a lot heavier weighted in those mid and small cap indexes. The VIX is back below 20 after spiking above 20, getting to the mid 20s earlier this week, back down and continuing to come off as stocks go higher, as volatility lessens up a little bit. Other assets, very quickly, interest rates continue to climb. This sort of started in the afternoon during Powell's press conference yesterday, has continued this upward climb as bond prices have come off and interest rates going up. The 10-year yield now back above 1.4%. The dollar index, by the way, down a little bit, still not a huge mover. It's been relatively trendless, I would describe it as, but down about 0.4% today. Commodities overall mixed, but it was energy related commodities up pretty good. Also, soft commodities, metals like gold and silver were all down. And that chart of the GLD has not gotten any better. We gapped lower today with the gap from yesterday's close, continue to push to the downside. We'll try to look at that chart here in a few moments. Cryptocurrencies, by the way, settling in. Yesterday was a big upside move for Bitcoin and Ethereum. Today, a little bit more, less of an upside thrust, but continuing to push higher with Bitcoin nearing that 45,000 level. And we've talked about 42 to 44,000 being a key sort of range. We've been testing that area, that range, very, very often in the last 24 hours, bumped against 44,000 a number of times, now has resolved so far to the upside. Let's look at a chart of the S&P next. So, overall, the real question is what's next, right? How does this long-term trend relate to the short-term distribution? And then on the tactical side, the last couple of days, you've had a nice bounce higher, and the S&P has actually closed the gap from last Friday to this Monday. So we talked about the four conditions to, in my opinion, indicate a transition from an uptrend to a downtrend. It's four very simple, technical characteristics. Number one, do we make a lower low? Number two, do we make a lower high? Number three, do we get below the 50-day moving average? Number four, do we get an RSI below 40? Let's quickly look through each one of those. Number one, do we make a lower high? And I think that's what's most important to be looking for right now. After you've had the sell off, we've tested the previous lows, we've now bounced higher. In a bull market phase, what has been happening year to date is every time that has happened, when we've seen this sort of pullback, we've rotated higher and made a new all-time high in the next week or two. That's what I'll be looking for now to see if that's able to happen. I think clearing that previous high of 44.50, making a new swing high, a new all-time high, would certainly invalidate any sort of bearish thesis, and I think set the stage for further upside. If we do make a lower high, let's say we go up to about 4,500 and then start to rotate lower, all of a sudden this has a very distributive pattern to it. This is what a head and shoulders top starts to look like, with a head and two lower shoulders. So the question is, are we forming the right shoulder now? And again, that is what a transition would kind of look like. Breaking the neckline of these intermediate lows is what would be so key. Number two, making a new swing low. We sort of did that, I think, earlier this week. And while we've bounced off of that level, which is totally reasonable, I still consider that level to be violated. And that's certainly putting the S&P more at risk of further downside. The third is getting below the 50-day. We did that on Friday with a close below the 50-day. On Monday, we had the second consecutive day first time that's happened year to date. We've had two straight days closing below the 50-day moving average. We've now rotated just back above it today, and I think further upside tomorrow would sort of continue that upside, take us back above the 50-day and eliminate that as a negative signal. The RSI dipped below 40, which in my thinking sort of puts the whole range more into a bearish condition. So at this point, it's gone from everything bullish to now sort of mixed, where you've broken a level, you've taken the RSI below 40. Now the question is, how do we resolve this current leg? Is this a bounce and establishing a lower high before the rotation lower? That would be confirmed with the break of the neckline of those swing lows. So the question now is, what happens first? Do we get above 45.50? Do we get it below 4,300? Take us below the low from Monday. That would be the indication I would be looking for, suggesting the direction of momentum. We talked about gold very quickly. I just want to highlight the chart of the GLD. It's been a gappy chart, if that's an appropriate adjective to use to describe it. Just a lot of movement. So now gold spot looks a little bit different, but we tend to use the GLD because I found a lot of advisors and individuals use the ETF because it's relatively liquid, tracks the price of gold pretty well. And so it's a good way of looking at it. So we've had a number of gaps actually in the GLD. After testing 171.50, which I maintain is the level, as long as we remain below that, I think the overall trend remains negative. What's happened though is we've gapped down a number of times. We've had a couple downside gaps during this downtrend. Each one of those seems to further validate the fact that we're more in a bearish phase. The fact that the RSI has come up to 60 on these bounces, but has never really gotten above it, sort of confirms the fact that overall we're in a pattern of distribution. Just like the S&P, and the question was, are we testing or threatening a head and shoulders top? The question here is, are we forming sort of a head and shoulders bottom, or what's called an inverted head and shoulders, or believe it or not, it's actually called a Buddha bottom for whatever reason, but that's kind of what that's called, where you have a low surrounded by two higher lows, sort of a head and shoulder pattern flipped over upside down. I think the name of the pattern is completely irrelevant. The main thing is, do we break the neckline? Anytime you see this sort of pattern that makes you start to think, all right, this is now the higher low. We're sort of rotating higher. None of that matters from a technical perspective until you break the neckline. So I continue 171.50, RSI 60. Those are the levels to watch. As long as we remain below that, gold certainly seems to be in more pain than potential upside. We talked about interest rates, and rates have come higher since the Fed meeting, really pushing to the upside. Highest 10-year yield that we've seen in the last couple months, just above 140. Last time we were there was mid-July, so it's been a couple weeks, or excuse me, a couple months below that level. Now there's a lot of daylight, a lot of upside above the current level that we're at to get back to the peaks that we saw there in the first quarter into the second quarter. This is when the 10-year yield ranged from around 150 up to 175. I think that's certainly possible that we could get back up there. It's worth noting, just like with the RSI on the S&P 500, looking at where that's at, looking at the same thing with the GLD. I think looking at that with interest rates is interesting as well. It's just hitting 60 today. So you're getting a bounce higher, getting the RSI hitting right at 60. The question is there enough momentum to push this higher? That would certainly put weight on the stock versus bond ratio, or at least illustrate further rotation to stocks, or continued strength in stocks versus bonds. Just to wrap up our market recap, we have energy, financials, all the cyclicals at the top, industrials, materials, technology, communication services, which at some points in the market cycle have been the story, are really in the middle. These are sort of market performers right around the averages. The underperformers, the only two sectors that are down, very defensive stuff, REITs, utilities below the zero line. We need to take a quick commercial break. We'll be back with my next segment, Getting Sentimental. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the technical activity in the markets. A couple quick announcements before we get to my next segment. First off, we'd love to hear from you. Feedback on your hosts, very, very welcome. Feedback on any of our guests who you'd like to see come on the show. We'd love to hear all of that, but especially we'd love to hear your questions. Questions as you're trying to navigate the markets using StockCharts.com, managing your portfolio, thinking about technical alerts and triggers and scans, all of that stuff. We're here to help point you in the right direction. Our email is the best to get a hold of us. It's thefinalbar@stockcharts.com. We're also on Twitter @FinalBarSCTV. We're on YouTube. Go to the Stock Charts channel, put a comment below the show that you're watching. We would love to hear from you. We'll hope to answer one of your questions in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. You can use your email address, set up a free account. You can start watching all of our great content immediately from your mobile devices, also from our website. Special events like the pitch, our mid-year market outlook, our year-end review coming up at the end of the year. All of that and more on demand from our website. Also from your mobile devices, just search on any of the app stores for Stock Charts TV on demand. Our next segment is called Getting Sentimental. A lot of the weekly sentiment data gets updated Wednesday into Thursday. And as I've talked about many times, sentiment for me is the third most important, from price to breadth to sentiment. That's the priority order. If I knew nothing else, I would want to know the price of the S&P or whatever market I'm looking at. Secondary to that would be breadth. And we talked about the breadth deterioration that's been playing out for months, right? I mean, since April, May, you've seen a steady decline in a lot of the breadth measures that we pay attention to. Third is sentiment. I think sentiment, while it's third most important, it's still very valuable because it helps illuminate the first two. It helps you think about what price and breadth are telling you relative to what people are saying, right? Price tells you how they're voting with their capital. Survey data, positioning data tells you a little different angle, a lot of ways what people are suggesting, where their heads are at. So we're going to start, we'll look at a couple different things. We're going to start with the VIX, with the volatility. By the way, the chart list we use for this is called Sentiment Indicators. It's part of the chart pack called Dave Keller's Morning Coffee Routine or something kind of like that. You have access to it if you're a Stock Charts member. To get to it, go to your dashboard, go to your chart list, and at the very bottom of your chart list, you'll have a little gray button in the bottom right that says Manage Chart Packs. Click on that. We have a number of free chart packs you have access to as a member, and one of them includes my checklist on breadth, on sentiment, and a lot of other good stuff as well. So the VIX, we talked about this consistent pattern of the VIX getting above 20, that coinciding with pullbacks in the S&P. This is a very easy game. All you do is you wait for the pullback every 3 to 4 weeks. You get a VIX above 20, you buy the dip, and the market goes higher. And that has worked for the last 5 to 6 months, and that's great. The challenge is that time it doesn't work, and you're sort of caught completely on the wrong side of things. So the challenge with the VIX is it's not, explicitly bound, right? The VIX can go above 20, but it could go up to 30, 40, even up to 80 plus, which is what we saw in March of 2020. So the challenge when you have an extended pullback is that it looks just like a buyable dip until it doesn't. And so I think seeing that we're in similar conditions to where we've been at recently is very, very helpful. Beginning started to look more like some of the viable dips that we've had has happened right around expiration, which is where a lot of these other pullbacks have certainly happened. So that third week of each month. But now all of a sudden things are starting to look different. The VIX has spiked higher than it's been since May. And again, in the end, didn't pull back much further than that. It sort of chopped around for a little while before resuming the uptrend. I would argue after May's pullback, the real all clear didn't happen until the end of June, right? That last part of June where he got finally above the high from May was important. So we've had this similar sort of situation. We had a new all-time high, a pullback, the VIX above 20. It's now back below 20. And the question is, do we continue to see elevated volatility? I would say the more that the volatility increases, the more it gets back above 20, the less this feels like a buyable dip, and the more it starts to feel like, for a historical analog, you need to look back to September, October of 2020, or other periods where you've had more of a prolonged pullback. That's why I think is key with the chart of the VIX. Does it get back above 20 here? The next chart is the AAII Bull and Bear Sentiment. This is a weekly survey of individual investors, and they are asked every week: Are you bullish, bearish, or neutral on stocks? And again, a relatively small subset of the investable community answers this poll. One of the great benefits of it has been it's been going on for so long. You can look at great deep history and look at what the markets have done relative to their sentiment readings and historical peaks and valleys. In general, the base way I would use this is a couple. Number one, look at the number of percent of bears. If the bears, or excuse me, the percent of bulls, excuse me, the green histogram here. If the bulls get above 50%, that's what I would call a euphoric range, where you have so many people that are bullish. It implies an extreme optimism, which is usually unfounded. And what you look for then is where you start to see some signs of breakdowns. Saw that, for example, in 2018, end of 17, beginning of 18, where you saw a huge spike with the bullish reading hitting 60%, which was an incredibly high reading. A couple weeks after that, you had a pretty severe pullback, which now afterwards has not looked as severe as you've seen some of these deeper pullbacks in terms of price and time. But that's something to look forward to. The other thing I would look for are divergences, right? We see the market going higher, but the bullish sentiment getting lower. And that's what we've seen in the last 6 months or so. When I think about a lot of the breadth indicators that peaked in April, for example, in April, 92% of the S&P above their 50-day moving average. Now it's down in the low 30s. I think it's like 37, 38% of the S&P above their 50 days. So that's a huge swing in a 6-month period. And that's a similar thing that we've seen 5 months or so, similar thing that we've seen in sentiment. Less and less bulls every time the S&P has gone higher. Finally, the spread between the two, which is net negative. It's been net positive for most of this year, save for a couple just blips below the zero line. This is the most that it's been tilted negative. So there are more bears than bulls. The last time that happened was during this recovery period, sort of after the February, March 2020 period. And most recently, it was September, October of 2020, which was when we had more of the sideways consolidation phase. So that's certainly a thing to look at, see if you get a continued string of more bearish sentiment and less bullish sentiment. Just very last thing I would point out is the name exposure index. It shows you positioning for active investment managers, money managers. You can see that's actually steadily declined here in the last 2 months. So as the market has gone higher, you've actually had lower exposure to the equity markets, according to this survey, which is sort of interesting, right? It's indicating a lack of confidence in the upside in stocks. Now that you saw the pullback this week, we're seeing that line continue to go down. Now net underweight, less than 100% equities, down around 78%. That's our segment, Getting Sentimental, where we focus on some of the sentiment readings. And again, that chart list is part of the chart pack you can access on your dashboard. It's called Dave Keller's Morning Coffee Routine. Our next segment is called ETFs Engage. I get a lot of questions about ETF, exchange traded funds, and their structures And again, I would always encourage you. We use a lot of ETFs on the show. We just looked at the GLD earlier. We use the SPY and the Qs and a lot of other things as well. The XLY, XLP, looking at and others looking at sectors. I would always remind you, ETFs are fascinating, and they provide such a fantastic opportunity for you to access markets that you would normally be very difficult to access. Right, putting together a basket of stocks in a particular sector is not super manageable for an individual investor, for a financial advisor, but ETFs allow you to do that. However, there's an ugly dark side to them, which is the structures can be a little obscure. You really have to do your due diligence to understand spreads, to understand the expenses, the management fees, and also the allocations, right? If you're not careful, you might be making some bet that you're not really comfortable with. You might be way too concentrated in a particular sector, a particular theme. And so make sure you do your due diligence. And this segment is meant to help answer some of those questions. Yesterday in the show, I highlighted this ratio, the high beta versus low volatility ETF. I just wanted to spend a few moments talking about those two ETFs and what they actually represent. So these are two different ETFs that we're looking at. We're doing a simple ratio. And again, the way you do ratios on stock charts, you do the first ticker, the colon, and the second ticker. This is the way, by the way, we always do relative strength at the bottom, looking at the relative performance of a stock versus a benchmark or something like that. You do the two tickers, one, the colon, and then the second ticker. So this ratio is showing you that high beta stocks have been underperforming, for this period. This is starting sort of June into early July. From there, sort of a sideways stretch where the two of them are in line. The reason why we highlighted the ratio, just potentially breaking out to the upside, showing that high beta stocks starting to outperform low beta stocks. So what do we actually mean by those two things? So it's two different things. The way that these ETFs tend to work, these factor ETFs, is you basically take a group of stocks, take the S&P 500, and you score them in a certain way. What is the beta of each of these? And beta is a measure of volatility. So a beta of 1 basically means this stock moves with a normal movement relative to the S&P 500. They tend to move with a similar amount of volatility. A beta above 1 means if the S&P would go up 1%, this stock most likely goes up even more than that, right? It has a higher sensitivity, where it'll tend to outperform in bull market phases. Also tends to underperform, right? If the S&P goes down, it tends to go down even more. A low beta, if a beta below 1, that means when the S&P goes up 1%, it probably goes up a little less than that, and that's the relationship. So what this high beta ETF is tracking a bunch of stocks that score high. So it's sort of traditional offense. The sectors that are going to be in this are things like financials, technology, consumer cyclicals or consumer discretionary, and then something like energy. And from there, it kind of tapers off. So this is a good measure of, in general, offense. Now, the other one, low vol, SPLV, sort of the opposite. These are low volatility stocks, tend to have a volatility less than the S&P 500, meaning if the S&P moves 1%, these stocks are tending to move a little less. So they're a little less volatile, a little less exciting, a little more conservative, a little more defensive. So these would be things, if you can guess, things like utilities, consumer staple stocks, healthcare would be in here, and a bunch of other things. So by looking at that ratio, essentially looking at the riskier stocks versus the non-risky stocks, or the risk on versus risk off trade based on that scoring model. So it's not 100% accurate in terms of understanding the dynamics of those individual sectors. But what I would encourage you to think about, if you're looking at that ratio, if you're looking at one of those ETFs, is really think about the sector exposure that you're getting to it and make sure you're comfortable with that. If you start putting a bunch of ETFs in a portfolio, you're going to be making some interesting bets if you look underneath and see where your exposure is. Did you guess what the mystery chart is? Let us relight the mystery chart flame here and see which. Can we guess what this is? I will start giving you some hints, by the way. And this was the chart that we showed you earlier. Again, dropping from a peak in January, hitting a bottom about a month after the S&Ps. The S&P bottomed out in March of 2020. This actually bottomed out a little lower, or a little later, about a month later, and had a lot further downside. So underperformed after the low. That's one significant hint. From there, it's actually had a pretty incredible run. And one thing I think that might surprise you is the fact that this ETF is up 53% year to date, while the S&P is up around 18% year to date. Do you know what it is? It's actually the USO. This is the crude oil ETF, the US Oil Fund. Now, it's an interesting ETF, and the challenge with commodity ETFs, I'll tell you why this is so important. A number of things. Number one, the challenge with commodity ETFs is they as time goes on, a lot of them get less and less accurate at tracking long-term trends in the commodity. And the reason is because the way you actually create that exposure can be a lot of different things. They could be using some sort of derivatives or swaps or something to try to recreate a return profile. they tend to track pretty well in the short term. So if crude oil is up X percent, the USO tends to be very similar to that, particularly directionally. But the longer that you look at over time, these commodity ETFs become more and more disconnected from the thing they're trying to track. So if you look at the USO for the last couple of years and you look at the crude oil future, which we can look at on dollar sign WTIC, you'll see that actually the returns are very different because over time there's an issue with how it actually creates that exposure and how it tracks it over time. It's interesting to note that if you look at year-to-date returns, you wouldn't think necessarily about crude oil being such a strong performer, but if you have USO in a portfolio, you've almost tripled the return of the S&P 500 over that particular period. I think the reason why the chart is so interesting now is it's reached that first Fibonacci level. So if you take the high from January of 2020, you take the low from April, you can see this whole time we've been regaining that first Fibonacci level, which we hit in June, July, and actually came off quite a bit. We're now rotating back higher and getting to that. And the way the Fibonacci retracements tend to work is the first level should be resistance. That should hold. If it does not hold, you go to the next level, which means we break that. That would indicate upside to 6190 or so on the USO, and beyond that, the next objective would be 7250. If you look at the chart of crude oil, you think about what that sort of move might mean for the crude oil future. Also think about what that might mean for something like the energy sector, which tends to correlate pretty well to the price of crude oil, because obviously that's the business that they're in. You can see that the XLE was bouncing to the upside today, getting above 50 on the XLE, which had been resistance for the last couple months. Some interesting rotation. I think crude oil at a very important juncture. If you've not been there, if you've not been thinking about energy and particularly the upside potential for crude oil, I'd be taking a second look if you could. We need to wrap the show, folks. Go to the 3 and 3 charts in 3 minutes. Here we go. The first is the ratio of consumer discretionary versus consumer staples. I've highlighted this ratio a number of times recently. I remember this came up with one of my guests. I forget who this actually was, who mentioned Todd Sohn from Strategas, I want to say. But we talked about the ratio of consumer discretionary versus consumer staples, particularly the equal weighted version. So the challenge with the cap weighted version, and this goes back to my ETFs Engage segment. We were talking about like high beta and low vol ETFs and just being familiar with what your exposure is. If you buy the XLY, you're not really getting a broad exposure to the sector. You're getting concentrated exposure to 3 stocks: Amazon, Tesla, and Home Depot. So if that's what you want, you have a great vehicle to do that. But if you want something more broad, you need to think about a different vehicle. The RCD is an equal weighted consumer discretionary ETF, gives a broader exposure to the space. And this ratio of consumer discretionary versus consumer staples, again, on an equal weighted basis, just breaking to potentially breaking to new 12-month plus highs. So if we think about the market getting defensive, we think about potential downside, which I am thinking about. A ratio like this breaking out certainly does not validate a bearish thesis on stocks right now. Number 2, we have energy. So stocks bouncing very nicely in the last day or two. The cyclical sectors are certainly pushing higher and providing some of the upside momentum there. The energy sector, the number 1 today on the strength in crude oil prices. We talked about the USO and its trajectory so far, broadly outperforming the S&P 500. And we can see that the XLE is back above its 50-day moving average, also breaking above swing highs from the last couple months. From a technical perspective, you look to upside to around 53 to 55. Those are the highs from March, April, May, and then we got above there in June up to 55. That's sort of the range. That's a good upside target given the strength and the rotation higher. And I would be watching that relative strength, which continues to improve. Finally, I did a presentation to shout out to the students at the University of Richmond. It spoke to their technical analysis class yesterday, and we talked about just how to be positioned in this sort of environment. What do you do when the markets are uncertain? You have an argument for the market going higher, arguments for the markets breaking down, stocks that are struggling, and I sort of put it in a couple different buckets. The first bucket, and I think CRL is a good illustration of that, are sort of the long and strong uptrends, right? Charts like Microsoft and Alphabet would fit this criteria. If you look at certain sectors, you probably come up with names that are just sort of up and to the right. If you drew this as a simple chart, you would draw an arrow up and to the right, and that's what these stocks look like. If the concern is, but is it overvalued? Is it too late? You know, on a chart like this, you can make that argument all along this way. Over the last year, many times you can make that argument. This is a chart that continues to go up. I would love to have a portfolio of charts that continue to go up and to the right. That is the game, and outperforming means you're outperforming a passive product. Folks, that is our show. Thanks so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.